We live in a fantasy world now. Reality has been destroyed.
This is the time that you really need to pay attention.
The probabilities are overwhelmingly on gold's side.
That is the best environment to see gold increase its value.
Welcome to Palisades Gold Radio. I'm your host, Tom Bodrovics. Joining me today is returning guest Luke Gromen, founder and president of FFTT, or Forest for the Trees. Thanks for joining me today, Luke.
Thanks for having me back on again, Tom. It's great to be here.
Excellent to speak with you again. And, I really appreciate you sharing your perspective with our listeners. We had a lot of great feedback on our last interview. So I was really looking forward to chatting with you again here. So you talk about inflation being binary. So could you explain that more for us?
Sure. So the binary really refers to, you hear the central bankers and the Fed talk about it almost as if it's a dial. If we can dial it up a little bit or we can dial it back down again. And the point about it being binary is that once you get beyond some threshold of debt to GDP, once you get to certain amount of financialization in your economy, as the U.S. have, once the government gets to be too big a part of GDP, for the U.S., I want to say federal spending is in the 30% range. You get sort of this unique cocktail, if you will, that, for lack of a better word, means you no longer have the ability to dial up inflation or dial it back down. It's a switch. You're either growing fast enough or you're not growing fast enough. And so when you're growing fast enough or inflating enough, then everything's good. Things are sure, inflation's picking up and it will accelerate, but you are growing the economy on a nominal basis, aided by inflation, by enough that you can service the debt and all those things. The flip side is that you're not doing enough. And if that's the case, then GDP is not growing enough to cover the growth in the debt. And basically, it leads to this really environment we've been seeing. I would say it started in late 2019, but has really, maybe even in late 2018, but it's gotten more pronounced where either the Fed's doing enough or the Fed's not doing enough. And that's how we've kind of framed this, this binary outlook, I guess, if you will, in that regard. Mm-hmm.
I have a lot to chew on there, and I'd like to get to a couple of different pieces of that. But let's maybe start by asking, how will this inflation affect the bond market? You've coined the phrase "get busy inflating" or "get busy defaulting," and that really sums up the two choices that the Fed has at this point. So could you explain both of those scenarios for us when it comes to the outcome for bonds at this point?
Yeah, I think they really come down to how, if you're holding bonds, it comes down to how you lose money. You either lose money by not getting paid back if there's a nominal default, or some sort of restructuring of the obligations. In other words, you used to get whatever. They gave you 30% less than they were going to give you, something like that. And to be clear, I think there's 0% chance of that happening in the United States and other Western sovereigns. Or you lose your money on a real basis. In other words, like we've seen for the last year, inflation runs 6 to 10%, and your coupon is 1 to 1.5%, and your bonds buy you a lot less food, oil, housing, gas, cars, computer, everything. So those are really the two ways out of it once you get to debt levels where we are historically, which is you either have a sustained period of significantly negative real interest rates, you inflate away some of the debt, or you restructure the debt, you default on part of it.
So can you give us let's say, a sense of the size of the bond market, and maybe what would it take for some of that capital to come out of that market and rotate into other sectors like gold or crypto?
I want to say in the U.S. it's more like $60-70 trillion bond market. I want to say globally it's 125 or 130 trillion, give or take a few trillion here or there, which used to be more money than it is now. But in all seriousness, I think we've been seeing exactly that. And you can see it really for the last 10, 12 years is if you look at the ratio of the S&P 500 over the TLT ETF, right? So the S&P over TLT, which is a ETF of the long bond, it rises when rates fall and vice versa. The S&P to TLT ratio is up nearly 5x since 2008. And it's the same, back in the end of '08, rates were basically zero. So you're 0% rate, 0% rate. You're talking about what's effectively a measure of the bond market escaping into more finite assets that better hedge, that have face values that better hedge inflation and currency debasement. So it's equities, it's real estate, it's gold, it's crypto. I would argue crypto and Bitcoin in particular have done the best job, in part because I would say it's one of the last free markets left out there. It's finite issuance. And I think ultimately a good way to think about it is historically for the entirety of my career and really probably since the early to mid 80s, there's been sort of this 60-40 portfolio mix. Maybe, they call it the 60-40 portfolio, right? So it's 60% equities, 40% bonds. And the 60% switches from growth to value. You can see growth and value sort of alternate in terms of being in vogue over the last 35, 40 years. But the bonds were always there because we were in a 40-year bond market. So it was switching back and forth between growth and value, and the constant was the bonds. And I think what we began seeing 12 years ago with the S&P over TLT rising the way it has off of lows, and increasing what we've been seeing in the last 5 years has been a shift gradually out of the bond market into anything else that better preserves purchasing power, that has a flexible face value, and in particular, maybe even the last 3 years. And so I think we're switching from this 40-year environment where it was growth or value plus bonds to, you have some value, you have some growth, you have some crypto, but it's all coming out of bonds now. That basically bonds are a source of funds, simply because I think there's a growing recognition that governments cannot allow asset prices to fall on a sustained basis. And so it's sort of when you hear people buy the dip, they're buying the dip out of bonds. They're buying the dip and risk out of bonds, or buying harder assets with bonds. So I think we're already starting to see that, and I think we'll continue to see that.
So when we think about a traditional default, Luke, and when we would actually classify that as such, you have an interesting perspective of saying that you can't just look at the interest on the debt, and you have to add obligations to that interest number as well. So can you break that down for us and explain to us why that number is so troubling?
Sure. So I really focus on the U.S. Some of Western Europe has similar types of problems, but the U.S. is the center of the system. It's the reserve currency. And so I spend most of my time looking at it from that angle. And the point is that I think you have to look not just at the interest expense, right? There's an article on Bloomberg today. Well, don't worry about the debt because the cost of servicing it is so low. And nominally, that's correct. The challenge is that that's just the interest on the debt. If we look at the pay-as-you-go portion of entitlements, that's what the United States has to come up with in cash to pay Medicare, Medicaid, Social Security, those other types of benefits that are promised. Those are obligations that total they're estimated anywhere from $100 to $200 trillion. And so if we think about those $100 to $200 trillion in obligations as debt, then the interest portion of that debt are the pay-as-you-go portions. Those are the cash outlays every year to float those obligations. And when we add together the interest expense that is not that big a deal to the entitlements, it's an enormous deal. And what we find is that we call that our true interest expense, which is interest or your total treasury spending, which post-COVID has lumped in some stimulus type programs that keep GDP high enough to keep things rolling along, shall we say. But we look at Treasury spending plus the pay-as-you-go portion of entitlements per the Treasury Borrowing Advisory Committee quarterly report. And what we find is that U.S. true interest expense, even with bubbles across virtually every asset class, true interest expense is still 111% of U.S. tax receipts. And what this implies is that if the Fed stops helping, if the Fed stops growing their balance sheet, the U.S. is short 11% of the amount just to pay baby boomers' entitlements and the Treasury spending. And that doesn't include defense, labor, education, veterans benefits, national parks, et cetera, et cetera, et cetera. So when we, I think it's really important to look at, and for me, I just use the true interest expense rather than anything else, because it's just a measure of something that's been said to me by a number of different investing graybeards, which is, listen, sovereign debt isn't a problem until you have to print the money to pay the interest, and then it's a problem. And my point is, we're already there. We were getting very close to that pre-COVID. COVID, it didn't just cross the Rubicon. I mean, we blew through the Rubicon. We are miles on the other side of the Rubicon post-COVID, and so here we are. It's a much more untenable situation already than I think most investors realize.
So this really, really points to the situation that we're now in, that they really can't have interest rates go up at all to be able to fight inflation as we have in the past. However, if they do try and fight inflation in that way, they're not going to be able to, as you say, keep up with these expenditures, right?
No, I think that's right. And it's critically, that's in no small part because they've allowed the economy to evolve in a way over the last 30 years, 25 or 30 years, that are very heavily asset price dependent in terms of driving consumer spending and therefore tax receipts. And therefore, anything that hurts tax or anything that hurts asset prices is going to hurt tax receipts. And so when you raise interest rates, in a highly financialized economy, a lot of these assets are very financially or interest rate sensitive, as most assets are. You're not only going to pay more in interest as rates rise, and we saw that to an extent when the Fed went through a tightening cycle in 2017 and into 2018. But you're also going to maybe more non-linearly lose tax receipts as asset prices fall over time with just higher discount rates, right? So basically, you would widen that gap that currently sits today at, call it 111% of tax receipts for just our true interest expense. You're going to see that widen out potentially non-linearly to 120%, 140% if they go too far in trying to fight inflation. And so you're in a situation where they really don't have the ability to fight inflation by letting rates rise like we did in the 1970s. Really, the only option is to basically grow the balance sheet further to contain interest rates. So it really, I don't think a lot of investors, I don't think that many investors see the potential for how quickly this could feed on itself, where basically the balance sheet begins to grow non-linearly as they try to control interest rates, which are rising as a result of inflation.
So, of course, there's another section to, in a way, defaulting that we've heard a lot about in the news right now, and that's the debt ceiling. So, is there any chance that we don't see the debt ceiling raised or discontinued in some way? And maybe try and add to that where that resistance is coming from at this point and why.
Yeah, I'd be shocked if they don't. I mean, to me, I just think it's this political grandstanding they're trying to get something else, and it's a political football from everything I can tell. And to be honest, I don't pay that close of attention to who's doing what and why, simply because my view of it is it's sort of two wings of the same bird. I've become admittedly somewhat cynical about the U.S. political process, and that might be the biggest takeaway from all this, right? Is as more Americans, as more foreigners sort of join my camp, which is this is the same stupid crap. And it's two wings of the same bird. They both spend ridiculously when they're in power. Nothing's going to change. They seem to be getting the one consensus that exists in Washington today is that deficits don't matter. And so for years and years, like everybody agrees with it. And so it's one of these things where, to me, I think the fact that they now all agree on it means it's probably just about time for it to be proven not true in some sort of very high profile way. Because the last time I can remember them agreeing on something like this, financially speaking, it was that home prices never fall nationally. The U.S. home housing market is solid as a rock in 2005 and 2006. So I don't, there's a lot better people to talk to me in terms of, who's doing what and why within the whole drama of the whole thing. But I'd be shocked if it actually leads to a technical default.
Mm-hmm. So you recently tweeted that if a heroin addict tapers how much heroin they've been injecting into their left arm with a syringe, $120 billion per month, but puts an IV into their right arm to steadily dose themselves with heroin as needed, standing repo facilities, FEMA swap lines, are they actually tapering? So is this a possible scenario as well?
Oh, I think it's the most likely scenario. I think the Fed will attempt to taper. But if you look at what they appear to be setting up alongside this quote unquote taper, they appear to be what one of my best relationships on the street called foaming the runway, right? Which is, and I thought they framed it really well, which was, if you look at all of the things that caught them and blew them up when they tapered in 17 and 18, and that caused the repo rate spike, et cetera, they're basically reversing all those things. So they're putting in facilities that will prevent those constraints from causing them to stop tightening, that will blow up as a result of QE taper. Now, the corollary to that is they won't be tapering anything. They will be nominally tapering. They'll be saying, look, we're tapering over here. And I think it's probably a very good thing for Fed credibility on the surface, particularly because if I'm right, it's not going to do a darn thing to asset prices. Asset prices are going to keep going up and up, and people will be able to say, Fed apologists will be able to say, oh, look, the Fed wasn't powering markets. They weren't, the liquidity wasn't having an oversized impact, or QE was not having an oversized impact on asset prices, because they're tapering and asset prices are still going up. But the reality, if I'm right, will be, well, of course it's not, because they're literally re-injecting just in smaller, consistent doses than the big sort of shot with QE, liquidity back into the system via some of these other facilities. So I'm watching how they structure taper very closely. I'm also watching the underlying economic situation closely, because it too is a fluid situation. Tapering today, even with these other facilities there, versus tapering 3 months ago in terms of the strength of the underlying economy, are two very different proposals or propositions. So we'll see. But that's what I meant by that, which is I think my baseline is they're going to taper. But I don't think they're going to truly taper, where they actually are really reducing liquidity. I think it's really a bit of a sleight of hand that I think is a Fed credibility improving exercise that doesn't change a whole lot.
Interesting. We really need to pay attention to the whole picture rather than just, quote unquote tapering, as you're saying. So
exactly.
I had the pleasure of speaking with Jeff Snyder last week, and he was saying that QE really only served to increase bank reserves. But how do they actually get that currency out into the market to spur the growth that they're looking for to increase, let's say, GDP?
Through the Treasury, through government spending, right? So government spending is 30% of GDP now. It's not an all-time record, but it was a few months ago an all-time record. It's still 10 to 12 percentage points higher than it was pre-COVID. And so if you do what they did in response to the COVID crisis was a classic definition of helicopter money, which is the government hands money to people. They issue treasuries to the banks sell the treasuries to the Fed for newly printed money. That creates bank reserves, and the Fed ends up with the treasuries. And so how does the money get into the economy? It gets in through, you can just see through the flow. Fed prints it, buys treasuries. Banks had reserves that they bought the treasuries from the U.S. Treasury. So the banks hands cash to government, government hands cash to consumer. So you can see the chain, right? So Fed hands cash to bank hands cash to treasury hands cash to consumer. So and we saw that there's no denying inflation. I mean, United States government, who is known for every government understates inflation, right? The cost of living increase adjustment for next year for Social Security is now being discussed to be 6%. That's an enormous number. It's the biggest number since 1982. So they absolutely can create whatever inflation they want to create, right? If we say extremes inform the means, if the government wanted to, the Treasury could hand out $1 million to every single American. They could issue treasuries to the banks. Banks could buy them, and the Fed could buy them from the banks. And we'd say, okay, if they did that, would we get inflation? And the answer is 100%. Of course we would. And so then it just comes down to, okay, how much is enough? And then do they have to continue it? And so they can do it. They did it. Will they continue to do it? And we're seeing some of that ongoing drama around the stimulus today that suggests there's a lot of reticence to continue to do it. Ultimately, they're going to have to do something for the reasons we talked about before. Is they don't really have the option of, not growing GDP very rapidly is no longer a policy option, and so I think ultimately will do what they have to. But that's how you get the money there. Is the transmission mechanism is just given the money is through Treasury. The government is such a big actor in the economy. The money's flowing in that way.
So as we think about, let's say, a possible way out of this situation, if we were actually able to grow GDP as you were just talking about, is there any way that they could start to normalize fiscal and monetary policy, and maybe to give us some perspective on that, how much growth would we have to see to be able to pull back from this cliff edge?
So there's a few different ways you can get out of it. Number one is an extended period of very high nominal GDP growth, so real plus inflation, while the Fed caps interest rates well below whatever growth rate that is, and we've calculated that at 15 to 20% nominal GDP per year for 5 years. That assumes the U.S. debt underlying is still trying to grow at 8.75% like it has for 13 years on a compound annual growth basis. And I think it assumes zero interest rates too. So that's a big number. That's option one. Option two is you have basically, and by the way, that's the way they got out of World War II debt. You got post World War II, you went from 110% to 55% debt to GDP in 5 years by doing a version of that. Option number two is a similarly massive increase in real economic growth. In other words, you have some sort of massive productivity driver where you can delever the economy because it grows in real terms so much bigger. And that would be some sort of revolutionary energy process or some sort of, nuclear fusion type of thing. I mean, it's a bit of a Hail Mary, but that's possible. Option number three is if you can somehow figure out a way to default on the baby, some big portion of the baby boomers' entitlements payments to them, and then also transfer a lot of their wealth, because the boomers hold about $35 trillion in wealth. If you somehow were able to default on those payments and get a big portion of that wealth to flow to their kids and grandkids who have a much higher propensity to consume, it's sort of a similar, you're basically going to be reducing your liabilities a bunch. You're going to be growing the economy much faster. It's going to be very inflationary, but that's another way you could conceivably do it. But those are basically sort of the ways out of that.
And to kind of clarify what you were saying about needing 15 to 20% GDP growth for the next 5 years, I believe you were saying we only have something like 6% now, right?
Something like that. Yeah, it's not even growing that right now. I mean, you would need basically 15 to 20% GDP growth at the top line while bonds yielded 2. And if you do that for 5 years, your debt to GDP will go from 125, 130% to 75, 80%. And then now you've given yourself more wiggle room to normalize policy if you're the Fed, without, you've basically turned the switch back into a dial, I think, where you do have a little bit more room where tightening won't just automatically sort of, hit the fuse switch over and into sort of not growing versus growing. You can have a little bit more leeway.
Yeah, it just serves to illustrate the point of how crazy and how unsustainable this situation is at the time, right?
Yeah, I think ultimately it's just I think it's right. I think it's the challenge is that these entitlement programs are so expensive. They're inflation adjusting. They're so big as a percent of GDP. They're so big as a percent of tax receipts, and they've been known they were going to happen for 70 years. There was no political courage for a long period of time in Washington, and now the piper needs to be paid. And so we're left with those three options.
Mm-hmm. So we, of course, have been watching the Evergrande situation very closely. And you've said that the sovereign situation backed by a sovereign bank is equivalent to not being around to hear a tree fall in the forest. However, you have warned about the transmission mechanisms as a secondary effect from that situation. So can you explain to us what those transition mechanisms are?
Yeah, I mean, ultimately, if you've got a state-owned bank who loaned money to a state-owned real estate developer, easy for me to say, in local currency terms that the state can print, then one default, there's no economic impact to the state of one defaulting to the other. You're moving accounts one to the other. The Fed can, the PBOC can print up the money. It's not a big deal. It's a domestic political issue, but it's not a big deal economically per se. Where the transmission mechanisms come in is if there's a decision that China makes that, hey, we're going to slow construction growth for 2 years, then you're going to see orders for cat tractor and a variety of different global industrial and commodity producers slow markedly and maybe go into recession. And tie back to that initial point is when your system is as levered as we are, you can't have a recession in anything of size anywhere, really, because the leverage is already inherent in the system through the amount of debt that everybody owes from the sovereign on down. So that's, I think, when you talk about the transmission mechanisms, that's how we've thought about the risk of contagion is not so much financial product to financial product. It's real world orders, ISM indices rolling over as a result of a potential slowdown in, say, construction activity or what have you.
So as we think about the global sovereign debt bubble, is China trying to manage, is exactly like you said, trying to manage some of these deflationary forces by letting defaults like Evergrande happen?
Yeah, ironically, they're actually managing it the way we should have managed our bank crisis 12 years ago, which is they're ring fencing it. They're firing execs. They're wiping out certain shareholders. They're restructuring the debt. They're keeping depositors. They seem to be trying to keep depositors whole in the wealth management products. It's sort of classic how you fix a banking system problem 101, or real estate problem 101. It's how we fixed the real estate, the savings and loan crisis and the commercial real estate issues in the late 80s and early 90s. It's how the Swedes fixed their banking problem. So I think they're doing the right thing. Ironically, they're doing the capitalist thing, whereas we did the centrally planned, bail out the banks and keep the execs whole and keep the bonuses whole, and which was not. It was sort of the Banana Republic oligarchy thing is how we did it, and it's really paraphrasing Simon Johnson, who was the former chief economist of the IMF, described it in 2009. So not really my words, more his. So I think they're doing the right things. Now, again, it just depends on what the contagion effects through the real economy remain to be seen. So we'll see how that plays out. Ultimately, they're in the same kind of boat as we are. They really can't afford to have growth slow in any real way for political and economic reasons. So my base case is they'll sort of do what they have to do to keep political and economic stability.
Yeah, it's interesting to really contrast both of those solutions to each problem, and see that China is actually doing the capitalist approach, maybe far better than we did. So
in a way, certainly, sure.
Yeah, absolutely. So as we think about other problems that can negatively affect growth, how is peak oil and the energy story playing into this situation here as well?
Yeah, I think we started writing about peak cheap oil. It's something I read a lot about in, I don't know, call it 07, 08 kind of time frame into 09, 10. And if you take a step back, what you find is that our global oil supplies have not really risen much outside of U.S. shale in close to 15 years. And in the meantime, demand has grown substantially. And so we've seen shale in the U.S. in particular buy some time because oil production is not, and this is something Matt Simmons and others have written a lot about, oil production in some of these fields, it is not a constant, once you find the oil, it produces at that rate forever. Simmons did a lot of great work, as did a few others, highlighting that these oil fields tend to have what looks like a normal distribution curve or Hubbert's curve, and in some way, shape, or form. And then if you look at the percentage of global oil fields that comprise, let me rephrase it. There's a surprisingly small number of global oil fields, Simmons called supergiants and giants, that comprise a surprisingly high percent of global oil production. The most famous is arguably Ghawar in Saudi Arabia, producing, call it 5 to 6 million barrels a day. I think it's 5 million barrels a day out of 95 million consumed, right? So right off the top, you've got over 6% of the world's oil being produced by just one field. And then if you kind of run down the next 100 super giants and giants, you end up with, I forget the number, but it's 30, 40, 50% of the world's oil. And the problem is that all of these oil fields have historically followed some version of this sort of normal distribution: discover it, tap it, production increases, and then it peaks and then rolls over and declines. And there's ways you can manage that process, but the punchline is that oil production hasn't risen in 15 years in any real way outside of U.S. shale. U.S. shale has masked that, but underlying this, you've had all of these supergiants and giants get 15 years older. And so now they are on average somewhere between 65 and 85 years old, which is very, very old for oil fields in terms of just when they usually go into some state of decline. And so we've got not just shale having a hard time growing and having masked this problem, but we've got the underlying a quorum of the underlying base of production of cheap oil, right? This is stuff. I mean, the Saudis' cost to lift oil is ridiculously low. The Russians in Samatlor and some of these other fields, ridiculously low cost of oil. And so as the supplies of these supergiants and giants peak and roll over, you're past peak cheap oil. And it's not that that we're running out of oil, that we won't find more. What it means is that we're replacing $2 oil with $100 oil. And so it just shifts the cost higher over time. And so the way I think about energy is ultimately nature's discount mechanism, right? It's all nature's, the true discount rate is you discount your economic activity by the expense of your energy inputs. And as energy gets more and more expensive, either the value of economic output shrinks, margins shrink, or you need to pump more fiat in to keep nominal returns and nominal GDP higher, which as a practical matter is a lot of what we've done for the last 50 years. So that's how we've thought about the energy inputs and how peak cheap oil filters into it.
And as you're talking about how the shale oil industry really has existed and grown over the past, let's say, 10 years, and we think about the EROI or the the amount of energy that we have to input to get that oil out of the ground, would the shale oil industry really have been able to exist or to grow without the advent of, basically super cheap money and completely financing it every step of the way?
Short answer is no. I mean, I think shale is a function of two things. I mean, they've known a lot of the shale basins, the major shale basins that have been so game changing for the U.S. have been known about for 25 to 30, maybe 40 years. The issue was oil wasn't expensive enough. And then the other, from a technology standpoint, that I think it's important not to undersell is the steerable long lateral fracking lines, right? So the fact that instead of just being able to put something down, frack and go, the fact that you can, go down, take a right, and sort of do like the Bugs Bunny thing, taking a right at at Albuquerque, and frack for these very long runs, thereby increasing the productivity of fracking versus what it used to be. I think those two factors, very expensive oil, and this technology changes, made the ROI such that it made sense. But ultimately, the cheap capital, has helped fund it at first. And now you're seeing there's been less supply response from shale to this rise in oil prices, in part because it's sort of once bitten, twice shy, or twice bitten, three times shy, depending on how you want to calculate it. But the cheap capital that flowed into shale in prior cycles is getting much more disciplined because I think there's just this understanding of, hey, we want to earn a positive return over the course of the cycle. We don't just want to maximize production. And so the short answer is, yeah, I think cheap capital absolutely had a lot to do with it, overlaid with some of the technological advances.
Excellent. So, Luke, I'd like to get some of your thoughts and allow you to expand on some of your recent tweets here. On September 24th, you wrote that by banning Bitcoin, China just broadcast to the world that it is afraid of Bitcoin. Are U.S. leaders smart enough to use that knowledge and use Bitcoin to America's advantage, or are our leaders too dogmatic, conflicted, and unimaginative? So how would America use Bitcoin to its advantage? Would they need to embrace it, in a way like El Salvador did by adopting it as another form of official currency?
I think if you just used it as a neutral settlement asset rather than official currency, right? So we would still use dollars, but if we used to back up, the way the system is structured now, America's role in the world is we have to emit dollars, and then we have to supply financial assets to people who end up with dollars for doing real work, for producing. And so what this ends up doing is hollowing out the U.S.'s productive sector, hollowing out the U.S. manufacturing base. It ends up hollowing out the U.S.'s warfighting capabilities. It's a brain drain because why would you go learn engineering, which is 5 years of school and hard work, when you could just go be in finance and make way more money than the engineers and the doctors will ever make, because you're moving money around. And that's been sort of the story of the United States for the last 40 years. And so if we want to stick with the dollar system, it's going to be really hard for the U.S. to win the great power competition against China, because our role is to simply provide China with the dollars to buy up the world and then supply China the financial assets. So in other words, sell our corporations to China for dollars we sent to China for stuff that China made for us. And basically, then Washington and others want to scream and whine about what China's doing. Well, we don't have a say. They've got the dollars, and we want to create a system where, okay, if King Dollar, you have the dollars, you get to decide. Well, China's got the dollars. So that's the problem of the system as structured. Now, if the U.S. adopted Bitcoin as basically the neutral reserve asset, in other words, we suddenly said, listen, China, your dollars are no longer good for our financial assets. We're going to settle our trade deficits in Bitcoin. Now, the price of Bitcoin is going to go to the friggin' moon. It's going, but the dollar is going to weaken markedly in global markets against the Chinese currency. And suddenly it makes sense for American corporations, American business to reshore and pay American labor. And so it would represent a massive reversal of the trend we've seen over the last 40, 50 years, which is industrials and labor lose, middle class loses, working class loses, and those in the dollar and treasury export business win. And Washington wins. Because right now, we've gone past the point where where Washington and Wall Street are going to win. China's going to win now. And so there needs to be a decision made. And so for China to say, hey, we don't want this, what an opportunity. Okay, great. Let's take this ball and run with it. And I get the sense there are some in the defense and intelligence establishments who understand this. I suspect there's a few in Congress as well, just judging by some of them that are pro Bitcoin. But it's a small crowd so far because there's just so much dogma attached to the dollar and the way the world's worked for the last 40, 50 years.
As you were explaining that, it was making me wonder what the chances of that ever happening were to be. But of course, we can expect miracles, but I don't know that we would ever see that come to fruition. What do you think?
I always go back to it's an apocryphal quote. I don't know if he actually said it or not, but Sir Winston Churchill apparently once said, the Americans always do the right thing after they've exhausted all the alternatives. Look, if we don't want our kids speaking Mandarin, we're going to have to do it because we'll lose. Like people say, oh, there's no way we'll lose. We'll lose. The rules of the game, America cannot win with the way the rules of the game are set up. China will win. So to me, some version of that. Now, we can make a case, would it be gold instead of Bitcoin? It might be. You're going to need to move to a neutral settlement asset to basically make the playing field fair. Because if you settle in a neutral asset, now it's no longer about, who has who's the financier and who's doing, who's producing and buying up the world's assets, and including the US's own assets. Now it's about who's got the better rule of law, who's got better environmental protections, where do people want to live, right? Where is there a brain drain versus a brain, attraction, right? So you actually level the playing field. And look, I think there's people in Washington that the concept of a level playing field scares the shit out of them, rightfully so. However, I think ultimately some move in this direction will be forced by markets or by geopolitical reality, which is, and I think maybe last year was a big move in that direction, right? With COVID, where you had these supply chain interruptions. And look, it might take members of Congress going to a store in Washington, D.C. and not having food there, right? Having supply chains break down, having their grandkids at Christmas not be able to get what they want to get them because the stuff's not coming. And at some point, I don't know what the triggers are in aggregate, but these types of things, particularly if we're going to maintain an adversarial stance with China, to think that China's not going to sort of do these types of things is naive at the very best. So I think there will be an inevitable move in this direction. We don't need for it to get too crazy to get there, but we'll see.
Mm-hmm. So you recently also tweeted that baked into the price and valuation of every single asset but one is an assumption of ever rising supplies of cheap and readily available energy. The only exception to this rule is physical gold held in your hand. Is this timeless investing lesson about to be retaught? So why is gold one of the only exceptions that has, priced in this framework?
So it's ultimately, if you have a gold coin in your hand, that's an asset that is nobody else's liability, right? So your money in the bank, you have a liability that is owed to you by the bank and backstopped by the government with deposit insurance. You have a bond, that's somebody else's liability. You have stock, you have a liability either unless you own the shares in person. You have DTCC technically is custodying your stock, or somebody else is custodying your stock, and you have a liability in terms of the corporation has to perform, right? If you own rental properties as an asset, the value of your house is dependent upon the price of oil, right? So if you own a rental house that is 30 miles from a major city and you're doing really well, and then gasoline goes to $30 per gallon, the value of your house will collapse because all of a sudden houses far from city centers will collapse in price. So it's in everything, whether people want to think about it or not. It is not in physical gold. Now, some people in answering that tweet made the point to me, look, you still have to pay for vaulting and storage and transportation. True. And my point and my answer is for sort of the middle holders of physical gold, that's true, right? If you're sort of, you own 3 coins, you can throw it in your sock drawer, right? And that's probably most households. If you're a multi-billionaire and you've got 100 million, 200 million, $1 billion in physical gold, or maybe even more than that. Let's say you're worth 50 billion, right? You've got, 5 billion in gold. You probably have facilities where you can just sort of, store that in and of itself, right? And maybe you've got other facilities, you got whatever. There probably still are storage costs, but the scaling costs of that are de minimis. So in the middle, yeah, there's still in theory sort of an energy cost of protecting it. But the punchline is really it's final settlement, right? There is that gold performs as an asset held in your hand. There's no other, it's energy already expended. Mm-hmm. Whereas virtually every other asset has a bet on the come, including gold miners, right? There's a bet on the come that they're going to expend energy and produce more gold. And the corollary to all this is, which it's not just a mental exercise, it's that if the price of energy rises, the price of gold should rise. And that's different than a lot of other assets, which is if the price of energy rises, the price of a lot of other assets should fall.
Mm-hmm. Yeah, as Steve St. Angelo likes to point out, gold and silver really are the energy equivalent value, or hold the energy equivalent value to get them out of the ground. And as you're exactly as you're saying, that's the cost of a gold coin already has that priced into it. So through that lens as well, I'd like to go back to Bitcoin and ask if the availability of cheap energy is going to negatively affect Bitcoin going forward, and could this open up the playing field for some more energy efficient cryptocurrencies?
So the way I've thought about Bitcoin is just that there is effectively, it actually has the tie to energy, obviously through the cost of mining. It's very elegant, really. And it will naturally, through just pure economics, incent the production of the cheapest available energy, right? I've ultimately thought about it as basically a negative, sort of at some point down the road, once you've mined all the coins and there's no longer the block rewards, then you're going to have to rely on fees to keep the network going, which is going to have a high energy cost. That in theory, you get to that point and you talk about what is really a negative coupon bond on some level. But again, I don't think it'll negative to holders of Bitcoin. There's just an ongoing energy input that has to be there and will be reflected in the price. So I think it works in the same way over time. It's just a technicality, I guess, really, where Bitcoin needs additional energy going forward, period. Mm-hmm. Gold held in my hand does not. And so from a purist standpoint, they're different. Will energy inputs for Bitcoin cause other, I mean, to me, I keep coming back to the benefit of Bitcoin is it uses so much energy. That's how the system protects itself. Ultimately, what central bankers are trying to do by debasing the currency is steal energy that I've already expended back from me, and back from us all. And so I think the energy expenditure side of Bitcoin is a total canard. Ultimately, I think it's because it can incent the production of energy from otherwise uneconomic areas, right? You have a waterfall in the middle of Africa. You can't run lines out to the coast, right? but you can put up in theory, a Bitcoin mining rig there, and you can mine Bitcoin there, and then the Bitcoin can move. And so you have sort of this, it's a very distributed way of generating energy, and capturing energy that otherwise is just being wasted. A perfect example is what we're seeing with flaring of natural gas and some of those powering rigs in the U.S., Bitcoin mining rigs. So to me, I think the expenditure of energy is, I think it's a feature, not a flaw of Bitcoin.
Interesting. So the last time we spoke, Luke, you brought up signposts and point them out regularly on your Twitter feed. So what have been some of the most important signposts that you have seen recently? How about the news story that protecting U.S. steel is a national security issue?
I think it ties back to a couple things. I mean, President Trump was widely vilified for trade protectionism. Yet here we have the Trump or the Biden administration doing something similar. And it ties right in with a defense pronouncement under the Biden administration of a couple months ago that was remarkably similar to a defense pronouncement by the Trump administration. And so ultimately, I think is two signposts. I think number one, the defense and intelligence departments are much more integrated or getting pulled into economic policy as a result of national defense interests. And that ties back to this dollar system, that the dollar system requires us to hollow out manufacturing. And we have hollowed out our warfighting capabilities too much. And so when you start talking about steel has been relevant and for in many people's eyes for decades. And yet here we have this being talked about. So, I mean, is it possible it's simply a nod to certain Democratic constituencies? Yeah, I guess. But, we got steel mills here and we voted for Trump in Ohio, right? So I think it's much more about this, particularly when you overlay it with semiconductors and some of the industrial policy we see. I think we're seeing a shift towards, this is the early days of a major move back to a better balance of industrial production with financialization. And as that happens, that signals a change in the dollar's usage, its structure as a reserve currency. So I think it's interesting from that standpoint.
Absolutely. Excellent, Luke. Is there anything else you'd like to add to our listeners before we wrap up here?
No, I think I've not seen this many crosswinds, maybe ever. I've been doing this 25 years, and the FFTT's been around for 8 years, and I don't know that I've ever seen as many crosswinds at one time as I do now. So I think it's going to be a really interesting, finish to this year and start to next year.
Yeah, that's a great way to put it. And of course, we appreciate you coming back on to share your perspective of analyzing these crosswinds and trying to give us some perspective of where things are heading. Of course, you're very active on Twitter at Luke Gromen. And for those listeners that would like to check out your website, it's fft-llc.com. Anywhere else you'd like to point to?
No, those are it. Happy to, if folks want to check those out, they can find out a lot more information at both of those places.
Perfect. Luke, thanks so much for your time today. Absolutely.
Thanks for having me on again, Tom. It was great talking to you.
This podcast is for general informational purposes only. Nothing on this podcast should be taken as investment advice. Guests on this show are not compensated for their appearance. Listeners are urged to educate themselves and make their own decisions. Do not base any investment decisions on the information contained. To view our full disclaimer, please visit our website.